Hey everybody, Signet here with the OEC. So in this video we're going to talk about a reversal pattern before a trend starts to form. This is the swing high. It's a 3-bar pattern that you'll find before a market trend to the downside. So the third bar signals that you've got the complete pattern in place, and from that point going forward you're looking for the trend to continue. Now this concept can be used on all time frames, but we want to use the higher time frames to perform our market analysis. So this is a typical swing high pattern, 3-bar play. Let's not use those words, 3-bar play. It's just a swing high pattern. So in the middle candle, that'll be your highest point. The third candle has to be completed before you can consider that the swing high has been completed. Now, after it's completed, what we're looking for is uh, a very simple concept that it's often overlooked. So here on TradingView, I've got a 3-bar marked out here, and what I want you to see is what the market does every single time a new candle opens. So I'm going to zoom in very extreme and just get in real close to this, and we're going to walk through what's going on here. Once you start to see this, it's going to be hard for you to unsee it. That's kind of the point. We want it to stick, right? Again, this can be used on all time frames, but we're looking to map out the next day's trading range and try to identify what we should anticipate for the day. So in this pattern, when the market closed down here, and I'll put the line in place, the new bar formed and price rallied up before continuing lower. It's important to recognize because when we get to the next candle, we had the same thing happen again. So we move this down there. The next candle opened, price rallied up before continuing its move lower. The next one, price rallied up. After the close, it actually gapped up, ran up, and then continued its move down and into the next one. Notice again where the market closed, it opened lower, rallied back up above the close before continuing its move. That very simple pattern right there is really overlooked in the marketplace. Here again, the market closed, gapped up, rallied higher, and then made its move lower. This pullback in the market becomes a trade opportunity all by itself. Just the concept that a market has closed and then it reopens should immediately have you asking the question, is this in a trend after a swing high or a swing low? And is there going to be a pullback? In that pullback, where is my opportunity to get a trade? All right. So eventually, of course, the trend ends and you get a swing low. We'll save that video for another day. What you want to watch for are inside days and outside days. So in this example here, we had a market trending to the downside. This one green candle is completely inside of the previous day's range, right? We have the high here, we have the low here for this candle, and this doji or hammer, whichever one you want to call it, this green candle right here, it stayed completely inside of the previous day's range. Now that's a completely fully formed strategy as well. It's the inside day. The inside day is often a precursor to a big move. Here's another one where there was an inside day, right? This big candle here, the next day price stayed completely inside of that candle, and then from the buildup of that energy and momentum, it broke out of it, right? So it doesn't always work out that way, of course, right? This was almost an inside day, but again, price compression, it's just showing compression in the market, and nothing in nature can be contained for too long. It's the reason they let water out at a dam, right? You can't hold back nature. So when a market gets contained like this, it's building up energy. We're looking for it to make a move out. So we start putting together the different parts and pieces, asking the question, are we in a move after a swing high or a swing low? Has price pulled back above the previous close before making its move? Where did we come from and where are we going? From that greater time frame perspective, you can go into the intraday and begin to identify what your opportunity is going to be. Where are you going to get in? What time of day are you going to get in? The lunchtime, the window, MOC, lock limits. We start to form all of these parts and pieces and put all of them together for a trade opportunity. Now, when we start using things like the NQ with the quarters and the roundies, then of course, it all just builds together. So get very used to the idea of looking at a swing high or a swing low and then stepping into the lower time frames and asking yourself, where is that pullback going to be? Now, here on the daily, these wicks don't look like they stopped at any particular spot. But if we had gone in and mapped out the previous day's price range, the high, low, close, the weekly high, low, close, the expected move, cog lines, any of those things like that, once the market opened and it began to rally to the upside, as each one of these did before continuing to go lower, we could start to identify where that rally could end, where the pullback would stop, so that we can get our entry for a short trade. All right. All of these parts and pieces are what form our trading opportunities. Price action combined with price structure is going to give you your greatest opportunities. Notice that we're still not using indicators. We have no need for an indicator whatsoever. All we need to do is look at time and use our drawing tools and map out the price structure for our anticipation. So I'm going to start to roll across the screen here and look again for another example that we can demonstrate. Here's a waterfall after a swing high, and even in this, it still resolved the question, right? One of these gapped so far it couldn't make it back, and it didn't even try. That was something that might be worth checking into. But you had the swing high. The third candle validated the swing high. The very next candle, what did it do? It pulled up into the previous day's range before making its move lower. The next candle, the same thing. So these patterns, once you start to look for these, you're going to get more of a perspective of what's going on in the market. And even when you can recognize that it failed to pull back, right? Because if it failed to make it across the previous day's close before continuing to move lower, that's going to give you a really great indication of how strong that move is. Right? Look at this day with this very big red candle. It didn't even attempt to go back and rally up above the previous day's close. That's a very big signal of how aggressive that market was to the downside. Every day somebody asks me how I know. How do you know? How are you so sure price isn't going to do this? Or how did you know price was going to do that? Well, we never know for sure, right? But there's enough signals, there's enough patterns, and when we put enough pieces together and we add enough ands, right, then we got a really good understanding of what we should anticipate on the day. All of this does repeat again and again and again. So we want to be able to recognize what that looks like so that when we start to see something we've seen before, we can say exactly, I know what's going on here. I saw this last month or last week or yesterday. I know exactly what we're looking for here today. Okay? None of this is arbitrary. None of this is just random walk. That is not a true concept. The market does make repeatable opportunities again and again and again. And it's our job to be able to recognize them, analyze them, use them for our forward guidance going forward. So welcome to the swing high pattern, and I look forward to seeing you at the next video.